What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about the message, a very clear message that the Federal Reserve, the FOMC, and Chairman Jerome Powell has for us that I want to dissect in this video, and also go over exactly the catalyst needed for both rate cuts and for markets to rally. So we're going to talk about that. And again, I'm not making a prediction here because predictions, most often don't actually turn out to be accurate because nobody can actually do that with consistency. But these are just things that we need to be aware of and just things that we need to watch and of course track in order to better understand from a risk reward dynamics, whether it's a good opportunity to dollar cost average and what needs to be done in the market depending on those different things, right? So hope you guys enjoyed this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. We'd love to have you on board with our MoneyVest community. There's 8 more days left with that 16% annual discount and the early bird investor tier. There's a few more spots left. So links are going to be down below if you're interested in joining, and of course, getting access to all the alerts, all the members-only private videos, intrinsic value spreadsheets. I will be doing a lot of buying over the next couple of weeks as markets continue to go down. So you don't want to miss out on those alerts, right? So links are going to be down below if you're interested in joining. So first things first, let's talk about where we are, right? So Federal Reserve obviously has paused now after their meeting from this week, and we are now sitting at the same level as where we were during the dot-com bubble at well over 5.25 to as much as 5.5%. Although markets a little bit more split in terms of expectations when it comes to the November meeting, and they're expecting maybe one more hike of 25 basis points. That's exactly what the Federal Reserve's penciled in. That's what they have mentioned in their summary of economic projections. However, the market's a little bit more split, still majority going towards a pause, but there is expectations of 27-30%, which I'll go over in just a minute, that they are expecting another rate hike, 25 basis points in 2023, right? So remainder of 2023, there's 2 more meetings left in November and December. Now, this right here is of the 19 participants, right? How many of them are expecting rate cuts, rate hikes, and whatnot in 2024? So there's 19 FOMC members, right? 19 people that sit on the Federal Reserve's, meeting committee, and 10 participants indicated 2 or fewer rate cuts in 2024. And that's one thing that I was kind of afraid of, right? That Federal Reserve's probably going to have fewer cuts in 2024, not because that they expect inflation coming down, but because they continue to see a very, very strong labor market and strong economy. And that's exactly why I wanted to put this together before the meeting. And we talked about it, during the live stream when the FOMC was actually, press conference was happening, the statement came out. But this right here basically tells us the 3 things that I was watching: the rate decision itself, the 2023 guidance, and the 2024 guidance based on their summary of economic projections. And we pinpointed exactly what outcome, what type of what type of result is going to lead to what kind of outcome, right? What the Federal Reserve does is how the market's reaction is going to be, right? Based on my expectations. No hike obviously meant neutral. 1 rate hike in 2023 meant also neutral. And we got hit on this item, which is 2024, which I've mentioned before. If we got 1 or more rate hikes or fewer than 3 rate cuts, right? That would be bearish for the markets. And exactly the last couple days, we've seen a pretty significant sell-off. On the week, we're down. On the month, we are down to September seasonality working like clockwork. And we are definitely selling off because we got a neutral, and then we got a bearish hit on this grid. And if I come back to this, what you'll notice is earlier, the Federal Reserve had 4 cuts, right? 4 cuts priced in for 2024. So what's happened in the last 2 months, 3 months that resulted in 4 cuts going down to 2 cuts? Because now we only have 3 members, right? We only have 3 members expecting 4 cuts, right? 2 members expecting 5 cuts. So in other words, out of 19 members, 5 have now expecting 4 or more cuts, which earlier this number was a majority. So this number was well over 11, right? So if you do the math, 11 divided by 19, we're looking at 58% versus 5 divided by 19 to 26%. So this number has been cut in half, meaning when there were just a few months ago over 60% of members in the FOMC. 60% might be a little bit low. I think it might be over 70%. 80% have to go back and check the dot plot, but it was a pretty significant majority of members expecting 4 cuts or more. That was the median, right, in just a few months ago. And it's now 26%, right? In other words, over 70% of FOMC members now expect fewer than 3 cuts in 2024. And that's exactly, over here. You can see 3 cuts, 2 cuts is obviously the median. 4 expect 2 cuts, and then of course 4 expect 1 cut. 1 person expects no cuts in 2024, and 1 even expects 1 hike. Actually, 2 hikes. 2 hikes in 2024. Right? What's changed? Right? Inflation's only moved in the right direction. Right? So why would they actually become less dovish, more hawkish with their expectations of 2024, right? In the last 3 months, the only thing that's actually moved in the wrong direction for the market, not so much for the economy, that is the labor market, right? The labor market is the breaking point, as I've always mentioned in my previous videos. So if you come over to the jobless claims, right? Especially if you take a look at what we have done since May, it's been really it's been coming down, right? I mean, we just hit a new 8-month low on initial claims. Unemployment rate has also been steadily declining, although it did tick higher. We talked about that in a very detailed video. I talked about the JOLTS numbers, the unemployed persons, and that ratio and how it's been coming down to more equilibriums. But the bottom line is that we have an extremely strong labor market, and the economy is just not showing any signs of slowing down, which hints that inflation will not be coming back down to target anytime soon. Now, this may or may not be true. This was Christopher Rupke, chief economist at FWD Bonds in New York, and the Fed was wise to keep another interest rate hike in their back pockets just in case, and it now looks like another rate hike is warranted or basically needed. And in my opinion, as I've already mentioned, the reason for the shift between all these FOMC members, right, from being somewhat dovish in 2024, expecting 4 cuts or more, to significantly less dovish and more so towards the hawkish side and expecting 2 cuts, fewer than 2 cuts in 2024, is all on the back of higher than expected economic growth and higher than expected or better than expected labor market. In other words, a stronger labor market. And that's going to be that starting point. Unless we see initial claims start moving higher, unless we see unemployment rate starting to rise, unless we see GDP starts coming down, I find it very difficult for the Federal Reserve to find a reason to cut rates in 2024. And, that's, what we've been talking about is that I've been more on the camp of a 1 more hike in 2023 and fewer cuts in 24. But that's also not been received well, right, among the audience, because it is what it is, right? The Federal Reserve needs a reason to do these things. They're not just going to do it out of the blue. They need a reason to be able to justify why they're cutting rates, right, or why they're raising rates. They need to address the economy. They need to address investors. They need to address the market. So these right here, again, are going to be some of the catalysts to really be watching. So rate cuts will happen and markets will rally when. And these are my expectations. Again, these are not predictions, but this is what I'm really expecting from the Federal Reserve and, what they're planning to do, and kind of putting myself in their shoes. Why they would do that is when jobless claims actually start going up. Unemployment persons start going up, right, which obviously is going to play into the unemployment rate, and GDP starts coming down. So they've given us a very clear message that this needs to happen before we start seeing rate cuts. This needs to happen. Otherwise, it's just going to be a stronger labor market, stronger economy. Inflation stays a little bit persistently higher than their target, and the Federal Reserve is going to be higher for longer. Rate cuts are not going to be even in their base case. So I wouldn't be surprised if in December, right? So here's the thing, right? By December is the next SEP. If in December they come out, or in that time period between now and December, we continue to see initial claims drop down to a 10-month, 11-month, 12-month low, and unemployment rate continues to be really low at sub 3.5, 3.6%. Let me ask you this, okay? If between now and December, right, that's when their next SEP is, unemployment rate stays where it is, okay? If anything, it comes down a little bit further. Initial claims hit a new 10-month, 11-month low. So we're looking at a very, very tight jobs market, very tight labor market. Inflation, core inflation stays above 2.5% or close to 3%. What do you think the Federal Reserve will put in their SEP for 2024? Is it going to be more cuts or less cuts? I want to ask you guys, okay? Because I want you guys to think logically, right? If you were the Federal Reserve and you were dealing with a persistently higher inflation of 2.5, close to 3% core, and you had an incredibly strong labor market and a GDP, right? What would you put down in December for 2024? Is it going to be more rate cuts or fewer rate cuts? Answer that question down below in the comments. I really want to know from all of you. So pause this video, comment down below, and come back. Because in my opinion, if that ends up being the case between now and December, I can tell you from my expectation, it would be fewer rate cuts, right? It could go from 2 to 1 to possibly not even a single rate cut in 2024. It's possible, right? If inflation doesn't come down fast enough and economy continues to be very strong and labor market doesn't break. So if that happens, of course, we're dealing with a lot of uncertainty here. Of course, rate cuts will happen and markets will rally. There's also a possibility that inflation drops down, right? So that's what we need to watch and wait for. Core inflation drops down sub 2%. That's probably the only goal that Federal Reserve is focusing on. Is the only objective the Federal Reserve has. Or I've got two other external factors which could result in rate cuts as well, which is any type of other crises, right? So we've kind of learned about the banking crises, but that wasn't enough for the Federal Reserve to kind of justify doing rate cuts. Any type of other crises that kind of, becomes a bigger problem, that's going to be it. And of course, any type of political pressure in 2024, as we've already talked about, it's going to be an election year. So any type of political pressure can also lead to rate cuts. Now, as I've mentioned before, in my opinion, I think bad economic data is actually going to end up being good market catalyst. So that's the crazy thing about the market, right? If there is poor economic data, that might actually increase the probability of rate cuts, which might end up acting as a very strong positive catalyst for the market for it to rally. Great economic data is going to be bad market catalyst, and that's exactly what happened with initial claims. When we got an 8-month low initial claims, that's great, right? Fewer people are filing for unemployment insurance. Unemployment rate's really low. That's great for the economy. Bad market catalyst, right? Selling off. So Powell and FOMC are basically punishing the economy and labor market for being strong. That's the clear message that I want to get across, is that they are punishing the economy and the labor market for being too strong. And of course, inflation is nowhere near close to their target. And as a result, fewer cuts and a possibility for one more hike. But I want to hear from you guys. What do you think? In the comment section down below. Let me know in the comment section down below what are your thoughts. But as always, if you enjoyed this video, found it helpful, make sure that you drop a like. Of course, subscribe to the channel, and link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, 16% annual discount available till the end of this month. And happy investing, and I'll see you all in the next video.